Thank you so much for your time, Devina. Now, let's start with the fund performance. Take us through the fund performance in the month of August, as well as for the year 2023, and any new trends that you spotted so far.
Okay, so our PMS has done extremely well, the equity PMS. In fact, since we launched 3.5 years ago, we have been right on top in all the multi cap, flexi cap, large cap space. So there's been a big gap. And in August also, we were up 1.3%, whereas, the markets were down. So it was
Hmm.
almost a 4%, I think 3.8, 3.9% point outperformance. Uh, this calendar year, it's been about 11% points outperformance relative to the indexes. And from the time we started in 2020,
Right.
we are up 140% plus, I think 142% or something, whereas the market is up about 82, 83%. So again, a big gap. And the strange part is that most PMSs have not even outperformed the market, let alone come very close to us. And the reason for that, I mean, Kshitij, you'd be surprised.
Hmm.
From the time we first had the PMS license to the time we launched a PMS scheme was a good 20 years. And
Yes,
the
yes.
reason
I,
for
you
that
know,
was that I felt that I should not take other people's money till I have a system where I can say there is some consistency, some foreseeability, some replicability. So only once I had that in place did I go into this space. And so, I mean, I don't mind being the first, as we were in globalizing, where we were not just the first Indian, but the first Asian firm to globalize outside of Japan. And I don't mind, in a sense, being the last to launch in this space, because, I mean, I just want to be confident that I can do a good job. So, more than, I mean, returns, of course, are great, but what really makes me happy is that on all risk adjusted return parameters, we are
right.
so far ahead that most people are not even at half our numbers. We always say you pay 60% of the fees for risk management and the balance for return management, because investing is a loser's game. You have to
Right.
ensure you don't lose in order to win. So, I mean, last year in the day Russia-Ukraine war broke out, market was down 5%, we were down only 1.6. So, I mean,
Right.
that's the sort of thing where this whole elaborate thing we have of risk, of a very systematic kind of investing, what we call a human plus machine model. I mean,
Yes.
strangely enough, I see nowadays people just copy the headlines. So I nowadays hear more than one fund and scheme talking man plus machine. So they've just made the human less inclusive. But I always think that somebody who can't think of an original three-word title, are they going to do the hard work and the rigor of the way we do this? I mean, because we literally have a million lines of code with extreme rigor. So the base starts with this artificial intelligence machine learning system, and then
Hmm.
you have, which itself codifies the 30 years of human expertise, and then there is a human overlay.
No, in fact, you've been the first ones to use the quantitative technology or methodology in picking stocks, and not just for India, but across the globe. And that is something which is very commendable. And yes, as you rightly pointed out, a lot of new schemes are coming up that are also, giving this flavor to the investment philosophy. But nonetheless,
Or rather the
uh,
label. I would say more than the flavor, it's the label.
it's the label. Right. Now that we have with you, Devina, we just have to ask you. Nifty at 20K or 20,000 at a time, when most of the global markets, and you track globe across, they're playing the catch up. What makes India sort of stand apart?
Okay, so now, Kshitij, again, I like to look at data. I like to look at the long view. So
Okay.
if you look at the long view for Indian equity markets, all of us have this figure in mind that equity obviously is a risky asset class and therefore gives higher returns. And we think Indian markets give about 15-16% per annum returns over a period of time. That's the figure most people have in their mind because that's in the compounding of the Sensex.
Hmm.
But if you look at the data, there's been very wide variation, not just from year to year, but from decade to decade. So in the
Okay.
80s, if you invested at the beginning of the decade, 100 rupees, you would have 700 by the end of the decade. But in 2010 to 20, you would have only 230 rupees, which would barely beat the fixed deposit, because those days fixed deposit themselves were 7.5%, and the equity market gave you only about 8.8% compounding. So there was a big gap, basically you were far below the trend line. So this was relative to your own history. If you again look at relative, you mentioned the global markets, that decade we mostly were in the underperforming bucket every year. So in 2020 and 21, when that trend decisively changed, I was quite certain that India's outperformance would continue, and which happened. So in 2022, which was a disastrous year for global markets, we were down in dollar terms, but we were still very much in the outperforming bucket. I think out of 42 countries, we were 10 or 11, something like that. So that we are still far below the trend line, because even this decade from the starting, we have compounded only about 12.5%. So nothing very significant. So I still remain positive on the outperformance. I still remain positive on the large caps, at least. So when we're talking Nifty, I still remain largely positive on that. And again, in market, you must remember that unless there is a big risk of a crash, at most other times it makes sense to remain invested. Because I had actually tweeted on March 28th this year that, if you don't invest now, you are much more likely to miss out on an up move than risk a crash. So, that was very clear. And I mean, we know ifs and buts. I said, and if you're asking me, is this the bottom? I don't know whether it's the bottom, but it is definitely in the range. From here, the likely move is up, which happened. And still, I remain positive. I mean, obviously, there's a move that has happening about 17-8% since then. But I still remain positive on the large caps, not necessarily on the small and mid caps and the more risky end of the market. But this space, I still think there is room, because you are still, in historical terms, not where you used to be. And also, if you miss out on 10 good days, 10 up move days in 40 years, this data I have shared many times, just 10 days in 40 years doesn't sound like very much, but you give up 2/3 of your returns. So, and if you miss out on 30 good days, which is not even average of 1 day a year, you give up 90% of your returns. So that's the risk of not being invested when there is likelihood of an up move. When the up move normally is an uncertainty. In a runaway bull market, you don't see an everyday move of that magnitude. That happened only once, and that was during the Harshad Mehta Teji, because that was a rigged market. Otherwise, it doesn't happen. So it happens when people are asking this question, not when people are, everybody is gung-ho.
Right. So the sentiment or the direction remains to be the same on the upside, even Nifty at 20K, Devina?
For the large caps, I would advise caution on the small and mid caps, because there people have forgotten the history of pain. For one thing, they have run, barring this week, that little bit of a correction. Otherwise, from that March thing, they have gone up 35 to 45%, depending on which index you look at. And the other thing is that, that index which came back in 2016 was not the index that went down in 2008. Because the interesting thing in small caps is that the index sees a churn of 18 to 20% every year. So in 5 years, actually, the basket is entirely different. So those, those stocks which made a high in 2008 actually never made a comeback, a whole chunk of them. So that there are many newbies coming into the market who do not have a sense of this history. I see even mutual fund flows are mostly going towards small cap schemes, and they do not understand the risk of this space. You only have seen this recent run up, and you think, there's a FOMO feeling, and FOMO feeling always leads you astray.